Hello friends, welcome to the next topic, that is interest on capital. Now a partner, he invests some amount of money. Let's assume he invests 10 lakh rupees in the firm. Now when he is going to invest this money, obviously he'll expect some kind of return, right? So that he is motivated to invest. Now the first return is obviously going to be his profits which he is going to earn from the business, but also he needs a guaranteed return. The guaranteed return can be in the form of interest on capital. That is, the partners might decide that we should pay a interest on capital for whatever amount has been invested by each of the partners. Now this is going to be defined in the partnership deed. So no doubt the interest on capital will be defined already, and it is going to be distributed to all the partners who are going to invest in the form of capital in the business. So this is how the interest on capital is going to be distributed. Now the doubt is on which portion should the interest be calculated, because there might be change in the capital during the year. So what are the changes as possible? There can be in the form of an additional capital introduced during the year, or there can be a withdrawal of capital during the year. Suppose they don't need so much capital, they can withdraw, or they need more capital, means they can have additional capital. So these two are the only changes that can happen in capital. Otherwise what happens, your opening capital will be the base for the calculation for your interest on capital. You should not take the closing, but you should take the opening for safety. So because the day you start investing, that is your opening capital, from there till the month till the accounting year completion, it has to be paid. So it has to be paid till which period? Till the accounting end. So the interest has to be paid from the opening period, that is, let's assume 1st April till 31st of March, that is your financial year closing. So to that period you have to pay the interest on capital. Okay, so keeping that in mind, so when you have an additional capital also, you have to pay interest from the day the additional capital is invested till the accounting period ending. Same way, if there is going to be withdrawal of capital, you have to exclude the interest from the day it has been removed till the year ending. So these are the three situations that you can face in a capital aspect. Now apart from that, so we know that there are two methods, right? Two methods of having capital account. Either you maintain a fixed capital or you maintain a fluctuating capital. Now fixed means what I said was right, but what about fluctuating? All your transactions are going to be part of the capital account and you are going to have a tough time, right? So obviously whatever additions we made in the form of interest on capital, salary, commission, or whatever deletions we did like drawings and interest on drawings, we have to do a reverse working now and find the opening capital. Okay, so we'll see that very quickly. So before that, we'll see the journal entries which has to be passed for with respect to the interest on capital. Now interest on capital is again an expenditure for the firm. Being an expenditure, we will debit that interest on capital account debit to partners capital account, and we will take it to P&L appropriation. So it will be P&L appropriation account debit to interest on capital. The entry is very simple. So I repeat it once again. Interest on capital account debit to partners capital, because interest on capital is an expenditure, we are debiting it, and we are making it part of P&L appropriation. So P&L appropriation account debit to interest on capital. So these are the journal entries. Now with this, we'll get into the topic, that is, let's go to 2.33 page number. You can see that how to calculate the opening capital. They have given the formats. When the capital is fixed, which I already explained, then when the capitals are fluctuating, these are the transactions. For example, you can see they are adding drawings, against profits, they are adding interest on drawings, then share of loss. Why they are adding all these items is that because these items would have actually been reduced earlier, right, from the capital. So we are adding them back so that we do a reverse working and get the opening capital. Same way, we are reducing additional capital, partner salary, interest on capital, and share of profits. We are reducing these items because these items would have got added to the closing capital earlier. So now we are doing the reverse working to arrive at the opening capital so that we can calculate the interest on capital. So these are the two aspects, that is when you are following fixed or fluctuating method, capital method. So you will do this. Okay, and you should be very careful with the period for which the interest has to be calculated. Suppose the additional capital was introduced in 1st of October, means you have to calculate for October, November, December, January, February, March. So 6 months you have to calculate interest. separately for the additional capital, and the original you can continue as it is for 12 months. You can apply the rate of whatever 6% or 7%, whatever is mentioned in the question. Okay, now there can be a situation in which the interest on capital is going to be more than your profits. So same way, what we have to do, what we have learnt earlier, when the appropriations are more than your profits, then what we have to do is simply take the ratio between the partners and split that in that ratio. Okay, let's assume, so the interest on capital was like in the previous example also, the total of the interest on capital was 2,80,000, but profits was only 2,10,000. You had a shortage. So we'll distribute this 2,10,000, whatever available profit is there, in the ratio of the partners, whatever interest on capital is there, we'll take a ratio of the expense ratio and we will divide that. So for that you can refer to page 2.31. There is a problem, illustration 16 is there, where the profit was 30,000, but if you see the calculation, total was 36,000 was the interest on capital. So partner A was to get 24,000, partner B was to get 12,000. So the ratio is going to be what? 24,000 is to 12,000, which is 2:1. So this 30,000 is the only available profit. We'll distribute this 30,000 in the ratio 2:1, that is 2/3 into 30,000. That means 20,000 will go there instead of 24,000, and for B, instead of 12,000 he'll get 10,000. So this is how we will distribute whatever available profit. We should not make a loss. Okay. Otherwise the problems are very easy. You need to follow the format of how you arrived from the capital at the end, how you made the additions, how you made the subtractions, and then you arrive at the opening capital. If you show the working for calculation of opening capital, that will be very good. You'll get full marks. And apart from that, then when additional topic in this is going to be transferred to general reserve. Like I told you, most of the time the partners don't want to transfer all the profits to their capital. They want to keep some amount as in general reserve so that they can use it in future. So keeping that in mind, so when we are going to transfer something to the general reserve, there are two methods in which you might transfer. Either you take a percentage on the net profits. Let's assume your net profit is 10 lakhs. Directly you take 10% of the 10 lakhs and you transfer that. Okay, on the P&L appropriation debit side it will come. Suppose the question says that it is going to be on a divisible profits. On the divisible profits means what? After adjusting all your expenses in P&L appropriation, whatever profit is left, on that you have to take the percentage. So you can refer to question illustration 23 on 2.37 page number, which will tell you how the divisible profit is calculated. You can see in the book the total profit was 8 lakhs, and then from there we have reduced interest on capital, we have reduced salary, then we arrived at the divisible profit 6,95,000. On that 10% we are applying, so 69,500 is transferred to the general reserve. So this is how we calculate the transfer to reserve. So these two methods are there which you can go through. Next we'll get into interest on drawing in the next video. Thank you.